In this video here, we're going to be doing an analysis on Sony. Now, this has been a company that I haven't touched in a long while, and with E3 or just around the corner, I figured, you know what, let's look at Sony Corporation because this is a company I eventually want to own, and I want to see what this company is all about. So we're going to load this up in a stock research tool to try to get a fair evaluation of this business and grade the business overall. So here in the stock research tool, we are grading this a 6 out of 10. And what this category and boxes do is it evaluates the balance sheets, the income statements, as well as the cash flow statements. And it comes out with a score based off those metrics to determine what its ranking is. So we're going to go through these numbers in a moment in this company metrics category here. If you're new to the channel, this is what compares the trailing 12 months categories of the company to the 5-year average, so we can try to almost cross-examine where this company lies and if they're doing better or worse than their 5-year averages. So sitting at $92 at the time of recording this video, we'll see where this takes us. I believe when I recorded it last, it was around $110. Anyways, without further ado, here's the financial evaluations. So jumping in with our PE 5-year average, we want to have this underneath 22.5, and we easily have that with 11.99. So we're going to get a point there in this category. So even here with our trailing 12 months sitting at 14.14, it's not bad. It's a pretty good score. Now, current ratio, we're going to lose a point here because it is sitting at 0.63. Now, folks, what we like to do here, folks, is I say folks a lot, and if you're new to the channel, that's just how it goes. I say that a lot. 0.63 is not a great current ratio. We want to see this number over our 1.5 1.5 or higher. Now that would indicate to us that they have enough assets on hand to cover their liabilities. This is important because if something like a recession comes or interest rates increase like we're seeing down in the US, these are scenarios that we want to be able to cover, and it being below 1 indicates that they have too many liabilities on hand compared to their assets. So 1.5 is a healthy number. Unfortunately, we don't have that with Sony, so they're going to get a 0 there. However, the next 3 categories are looking pretty healthy, with return on equity average being over 15%. It's going to get a point. EPS growth, phenomenal EPS growth. Now, these numbers here, just to keep in mind, they look like they're massive, but keep in mind it's reported in Japanese yen. Eventually, when we do a price analysis, this will be converted to US dollars. So, huge EPS growth there, a very low debt to equity ratio. Now, this is super important, folks. We want to see this number being underneath 50%. Now, that would indicate to us that they're growing the business through equity and not through debt. So with a low ratio like that, it's very comforting to see as a potential investor because they're not taking on debt to grow this business. And as I said earlier, this ties into almost to a current ratio because we don't want to have too much debt on file. Because if things hit the fan and we can't pay off our creditors, guys, then it's not good for the business in the long run. Share dilution, we are being slightly diluted. Now that just means that they're sharing the profits with more shareholders at 0.75% increase. It's not the worst. It's an increase nonetheless. That's why we're giving it a 0, but it's not the worst thing if it's this low. Now, net income growth, we're up. However, our free cash flow growth is down, and that's not good. That's down 20%. Let's look at the cash flow statement real quick and just see what is going on here. So going back to 2014, you see we're at $380 billion. And now it's been somewhat of a rocky ride, but major increase from 2017 to 2018 as we're sitting at $991 billion. And then slowly but surely, however, we are down, sitting at $792 billion in free cash flow from our lovely highs in the 2019-2020 era of 900. Now, I'm going to just say, due to everybody being inside and due to everybody being inside from the pandemic, the PlayStation 5 coming out, there's a lot of the titles that were released at the time, that those numbers somewhat are somewhat justified because, and there's somewhat of an anomaly because you have all these people just inside playing games. And now that the economy is starting to open up, maybe sales are slowing down a little bit because there's such a shortage of PlayStation 5s. I don't know about you, but if you talk to anybody that's been trying to get a PlayStation 5, they're still backlogged or being sold way overpriced than what they're actually worth. So that's far from the matter. But that could be a contributing factor, as well, if you're not able to get the system to play the games, how are you going to play the games, right? And that's the main money maker. So with that in mind, we're going to look at the return on invested capital average sitting at 5.46%. That is not great. We want to see this number over 10%. Unfortunately, we don't have that in any of these boxes here, which is unfortunate. And our revenue growth is 5.66%, and that's up. That's not bad. I'm glad that it's up. $114 billion company. They have a lot of their hands in a lot of different things, from music to games to TV shows to movies. This company stretches on all bounds. And what's interesting about Sony at the moment is that now they're taking a leap into the television world by bringing some of their video game series and their IPs over to that era. That form of medium. You have shows like God of War that has been introduced. You have Last of Us that is going to be coming out very shortly, and that's a Sony exclusive. You also have Horizon Zero Dawn that's also going to it's been announced that will become a TV show. So they're trying to incorporate all their IPs into while taking it not just from being a video game, but now over to being a television show, so another form of medium to bring in more cash flow. That to me is very comforting to know that, you know what, they're building it more further beyond than what the medium that it was created for. So I'm glad to see that development is happening. So hopefully in the next couple of years that will definitely pay off. I'm very curious to see how this Last of Us TV show pays off, because I'm a huge fan of the video games. So we'll see what the series is all about. Now, those are the financial evaluations. We're grading this a 6 out of 10. So my thoughts on this so far: share dilution is not the worst thing. However, current ratio is the one thing that's going to be concerned, and our 5-year free cash flow. Now, if this is being invested into all these television shows and stuff like that, because that's one thing you can do with your free cash flow, is invest back into yourself. This might pay off down the road. However, it's not a comforting number to see. Ideally, I like to see just an increase in free cash flow steady over year. Now, we don't pay any dividends, but we cut it out. But we did pay, a small one, $74.3 billion, and our average free cash flow is $895 billion. That is obviously in yen, folks, so just keep that in mind. And yeah, our terrible Almond Z-score and a terrible Piotrowski score sitting at 5 and 0.51 respectively. So now, with that in mind, yeah, my thoughts on Sony are still pretty much echoing what I was saying before. I think there's a lot of great ideas with the business, and I think they're in this investing phase where they want to just start ramping up onto, well, pretty much kick it into high gear, because they are trying to acquire Bungie. They are trying to get their IPs out and into different TV shows, as I mentioned. So they're making moves. They're planting their pieces. It's whether or not it's going to pay off or not. That's a big question. So with that in mind, we're going to do a price analysis on this business. And what I like to do, what I mean by price analysis, is we're going to put in some assumptions of this company to see where it will be in the next 10 years. And we'll calculate it back, and we'll get an average price calculation of what we should be paying for this company to get our desired return. So I'm going to fill out these boxes here. But before we do that, folks, if you are enjoying the video so far, please hit that like button and the subscribe button. It means a lot to me, it means a lot to the channel, and this software here is currently being developed into an app for you to use so you can analyze stocks within an instant. So just stay tuned for that. It's coming out hopefully soon. I'm working diligently day after day to try to get this out for you. Alright folks, so here's what I did. If you know me and you've been watching the channel for a little bit, I like to be conservative, as we all should be. We are value investors, so we have to make sure we have a proper margin of safety and buy businesses that are within that margin of safety. So here we go. So with our revenue growth, I took a very conservative approach, putting 5% on the high end because I know they can hit that with our 5-year numbers here, as well as our 10-year numbers are hinting towards that. So going with 3, 4, 5. Now, this might be a little bit too conservative, I'll be honest with you, because with a lot of things that are in the pipeline, we might see huge revenue growth with Sony. But we'll go conservative nonetheless. Profit margin, I'm going to keep it at 7, 8, 9, and free cash flow margin the same thing because I want to juggle between this 9 number in our 5-year range, right? And I believe since they've expressed that they can hit that within a 1 year, I might juggle it in as well. But 9 being the highest that will possibly go, and keep it at 7 because it just makes sense. I could go lower, but it doesn't make sense to be much lower than what we've shown in the 5-year number. Price to free cash flow, same thing, 12, 13, and 15. I'm going to just hover around what we've been given and sticking with a low PE ratio because as this company grows, you should be paying a lower, or as it gets larger, you should be paying a lower multiple for it because it won't be growing as quickly. Hence the conservative revenue growth. So with that in mind, we're going to put a desired return as 13%, lucky number 13. And okay, very interesting. Currently sitting at $92.26. Average calculation comes out to be $78.35. However, on the high side estimates, we are in the buy range, sitting at $103.50. That's assuming a 5% revenue growth, which is possible, profit margin, which is possible, free cash flow margin, also possible, price to free cash flow, also possible, and a slightly higher PE ratio. So folks, if you agree with these numbers here, then technically Sony is a buy all day because look at this discounted cash flow formula, 96.21. That's almost on par for what we currently have. So to get a desired return of 13% over the next 10 years, you would have to pay $103. That is lower than that. Listen, folks, that's just the math and how it works out to be. Now, what would I do? Well, I would like it to sit between these numbers ideally. If you watch the videos, and the growing trend is I like to find companies that sit within our conservative and moderate categories. I like to have a decent margin of safety because if anything goes wrong, at least I know I won't be losing that much. And sitting between $55 and $75, it might be possible. This is a company I get excited for because of what they have going on, because of their television shows and what they have in the pipeline, and just because of their stance in the gaming industry. I love Nintendo consoles. However, there's no denying that Sony is probably the second best. So no, they are definitely one of the top, like the top dogs creating new standards in gaming. There's a lot that this company offers, and I'm only focusing on one thing, but look, if you just come down to the description, and we have the description box here, what they deal with. There's research, there's distribute, sells, and services, televisions, there's video game and sound projects, interchangeable. They have their lens, there's their camera lines. They have their Sony A6000s and A7Ss and stuff like that. Their major television shows shoot on Sony Venices. There's so many things that this company has to offer. Closing thoughts on this business is that this price needs to fall down in order to make sense. I'm very curious. I got to revisit this whole Bungie scenario. That would be very interesting if they're able to acquire them. But it's more so their television media, and that has me really excited. Granted, esports and video games is never going to go away, but it will be a huge growing industry. But as we begin to see this shift of storytelling from video games over into television and movies, Sony has a lot of interesting IPs that I feel like that's going to bring a lot of revenue. You're going to get kids and young adults hooked on the television shows like The Last of Us And then they could realize, wow, wait, there's a video game based off of this story. I love this story. Let me go play the game. It's a phenomenal game and a phenomenal series. So they're just trying to marry these two ideas together. And I think that's very smart. But my consensus is this, based off the mathematics. If you believe these numbers here, it's a buy. If you don't, it's somewhere in here. And that's Sony. That's the video. Thank you for watching. I will see you in the next one. And I apologize. I should have said this at the beginning of the video. If you've gotten to this point, I apologize for no video on the Monday. Life gets in the way sometimes. And yeah, see you in the next one. Thank you.